wanted to talk kind of briefly about the FOMC minutes tomorrow. So we already know the Fed's decision, right, and the outcome of that decision. And obviously, it was the last FOMC meeting was a big part of what continued to drive, the sold call squeeze higher in December. But there's a caveat to that, and that's that the voting members of the Fed that voted on rate cuts largely are being shuffled off of the voting board into this year. And being replaced by, I believe, Daly, Barkin, Mester, and Bostic, all four of whom have come out and pretty openly contested rate cuts in the early half of 2024. So, since they are all going to be voting members this year, that means that the dovish members on the Fed board are going to be replaced, and that is going to skew the potential for outcomes in the Fed's dot plot. And so, depending on how they voted going into tomorrow's FOMC minutes, we could end up with a really bearish outcome from those projections. Now, these were the voting members that drove our price action in 2022, right? Cycling back in. FOMC minutes is at 2 p.m. tomorrow, always. Everything from the Fed, 2 p.m., right? Except the presser, which is at like 2:30. And there's no presser tomorrow, it's just the minutes. So yeah, a bunch of the doves are shuffling off of the committee, and the four new voting members are all quite hawkish. And right now the market's pricing in 6 rate cuts. It's very likely we come out of the meeting tomorrow with the market being forced to price in closer to the Fed's 3. So let's say like 4-3 rate cuts. I can see us holding 4 rate cuts into the actual FOMC meeting that's coming up in Jan, and then moving to 3 if guidance continues to be hawkish. But the market will simply ignore it. They may not. I think things are broadly turning bearish anyway. I mean, we've got yields starting to move back up. They're leaning back into the carry trade. I think the market might pay more attention to it than they would otherwise. Also, we have jolts tomorrow, which is important. Obviously, bulls want to see moderate gains in job growth and or a decline. So weakness in the labor market to indicate that the Fed is indeed done hiking. A strong print for jolts, more job openings, means a continued strength in the labor market. And that's, while bullish for the economy, it's bearish for the idea that rates will be cut anytime soon. The market has 6 rate cuts priced in for the first quarter. No, they have 6 rate cuts priced in for the entirety of the year. They really should have kept their foot on the rate hike pedal back in August. Yeah, but that's if you assume that the goal here was to solve inflation and not simply suppress inflation. And while I don't like to think that the Fed is politically motivated, if they were, then you wouldn't want to solve inflation until after the election, right? Yeah, dual mandate and all that. But they've leaned harder into the labor side of the dual mandate, right? Maximizing employment rather than in the price stability side of that dual mandate. And that's what propagates soft landings. But soft landings almost always guarantee a recession and an additional increase in inflation down the line. I think Jeffries may have been onto something with what? Oh, with that whole thing? Yeah, that was kind of crazy though. Anyway, we had a nice test of the bottom of our bear range today. And look how remarkably my little lines stood up to that test. And a bounce and move higher, but still within the range to see a continued breakdown. I wouldn't say that technically we formed any kind of bullish pattern here. If anything, we're seeing an additional broadening wedge. This really just implies that there's increased volatility. It's not, I wouldn't say it's really, it probably leans a little more bearish than bullish, but it's not indicative of bearishness. A continued failure to break the 4,800 level though is, and as the days go by, gamma neutral on the monthly contract is going to move closer to spot as well, and that puts us in a range where more and more bearish price action can see bigger and bigger continuations. So if we're not already in the beginning of a breakdown. We're getting very close to it. So we'll keep our eye on those levels, but tomorrow's data should have a pretty big impact, I think, over the rest of the week. I mean, we have non-farm payrolls and stuff on Friday, and obviously those are very important as well, but for now I think we're okay. Yeah, I think that's about it for that. Broad commodities down a little bit today. China not doing well. Their Kaixing manufacturing report, not so hot. Definitely not what people are expecting. Flat instead of up. Yields up quite a bit today, from the 2% on the 5-year all the way out to 1.61 on the 30. So we're starting to see the back end of the yield curve pick back up again. Correlation still hasn't turned around very much. Lots of vol shorting. So we're not really seeing any easing in that index vol shorting, but we are starting to see the 3-month kind of come around, and you can see that here with 3-month vol still running a bit hotter than like VIX cash or spot VIX. We have, and this is even more obvious here, where we have a very sharp upturn in the yield of volatility, which is moving much closer to positive as we see the Japanese USD JPY carry trade start to turn around. I think this is going to get leaned on more and more as we approach March and the BTFP decision, because I think banks want to use this period of time where rates are definitively not being cut in order to leverage up the carry trade, lend as much as feasibly possible in order to improve net interest income. Right, so you're probably gonna start to see a lot of like low down payment, lower interest, and deferred payment incentives on loans, and possibly better credit card deals over the next few months. Why? Because they want to loan as much as possible. So you're going to see like low down payment mortgages. You're going to see low interest offers on vehicles and vehicle financing. You'll see deferred payment offers on vehicles, vehicle financing, and durable goods financing. So keep an eye on that, especially if they lean harder into the carry trade again. Poors are always interested. That's the great thing about them. They'll keep doing the same stupid shit no matter what. No problem. No update on move yet. Skew kind of turning up a bit today. Leaned real hard. Holy shit. What is that? Is that 26.27%? Almost the largest volatility short in history since the week before April of 2010. What the happened after that? Oh, that was like the double dip in the big recession. So the lowest the largest vol short in history, greater than Volmageddon since there. And that was followed by about a 17% drawdown in the SPX over, like 8 weeks. That's interesting. That's maybe a big deal. Still 83.1% of the SPX above its 20-day moving average. So still not a lot of damage dealt. Yeah. Anyway, thank you guys so much for tuning in. We'll see you bright and early tomorrow morning. Have a great night, everybody. Later.